Well, yeah, I just remember last time I probably gave the best remarks of my life for the 25 minutes when nobody could hear me.
No, we could all hear you. We just couldn't, you couldn't hear any of
Hear,
us.
hear us. Well, that's probably about right.
All right, we're open, it
So,
looks like.
so who do we have out there? Where are they from?
So far, no chat responses.
Let's ask them where they're from.
Did that, they're just,
I'm here in Pro. You can see me, Jim?
yeah,
Okay. And you can see the slides.
yeah. Oh, we've got
Great.
Bert from Daytona Beach.
But our brother or a different Bert?
No, that different Bert.
Okay.
We've got Bala, Michael from Cleveland.
Great. We've spent some time in Cleveland. Fun
We've
time.
spent some time in
Rock and
Cleveland.
Roll Hall of Fame, baby.
Yeah. Kimball from University of Victoria in British Columbia.
Ah, beautiful up there.
Pretty part of the world. Jingxi. I'm sorry, I may not pronounce that right. Like we've got about 20 people logged in so far. Came from Saddleback College in Mission Viejo. Logan from Indiana.
Great.
Justina, Penn State, Burrend. I'm not going to get all these names right. Robert is in Kentucky, Louisville. Paula's from New Brunswick.
I'll bet it's cold up in New Brunswick.
It's New Brunswick, New Jersey.
I'll bet it's cold there too.
Yeah, I bet you're right. For those of you who are just joining us, we'll get started here shortly.
Jim, if you could ask some of them to raise their hand to make sure they can hear us.
Let's see, can someone in the chat confirm they can hear us, or are Kay and I just talking to each other?
Yeah, again.
Yeah. Yep, we're good.
Perfect.
Thank you, everyone. That's wonderful.
Well, I'm looking out
Excited
my
everyone's
window.
here with us today. This is going to be fun.
I'm looking out my window and I can see a little snow on top of the mountains out there, just a little.
Yeah. Yeah, fall fell and brought some snow with it here
That's
in
right.
Utah. Okay, Kay, we got 10:01.
You tell me to go and I'll go whenever you think it's time to go.
Well, we told people 10 o'clock and we're people of our word, so off we go.
Let's do it. We're here to talk not about ESG in general, because there's a lot of things to talk about with respect to environmental, social, and governance, but we're here to talk about how we might incorporate that into our introductory accounting courses, specifically as a measurement issue, and also interesting auditing issues associated with it. So our students are hearing about ESG. It's a thing that's out there. This would be a nice way to get our students to see how modern, relevant, and important accounting is. So that's our focus. Well, let's start on an interesting measurement issue. Jim, if you'll monitor the chat, any thoughts on what's the #1 cause of death in the United States? And I'll give you a hint, it's not accounting. So anybody have an opinion on what's the #1 cause of death?
Stress.
Stress is getting there, I'll tell you. That's interesting. That's a very interesting.
Suicide, auto accidents, heart disease, car accidents. So
These are great answers. Well, this is from the Centers for Disease Control. the National Center. Heart disease is number one. Then cancer, COVID. These numbers are from 2021, and we've learned this terminology when we were dealing with COVID. Comorbidities. One comorbidity or a contributing factor to many of these things on this list is obesity. As in the United States, many of us probably weigh a bit more than we should. For example, here we go. There's the classic American meal, the Big Mac meal, and we're not going to supersize this thing. Any opinions on how many calories are in that classic Big Mac meal? Anybody got a thought on that? And it's less than a million, I'll tell you that.
Ed says 1,200. Bert says
That's pretty.
1,720. Mary,
1,200 is
Lynn,
a pretty.
2,500. So we're
2,500
getting
would mean
guesses.
more calories. These are good answers. It's 1,120, which is 50, and that's the normal size. That's not supersize. That's 56% of the calories that you should eat in an entire day for an average person. So these causes of death, many of which are worsened by consuming too many calories, this is what we're dealing with here. We as a people maybe eat too many Big Macs. So I found in life, and as have you, if we've got a problem that's tough, let's turn to accounting. Can
Call the
accounting help
accountant.
us? Yeah, can accounting help us in eating fewer calories and in eating better? Well, it turns out that accounting can. There's the movement to post calories on menus. I was in Costco just yesterday looking up at the hot dog sign and the pizza sign, and below all of them, it's the number of calories. Well, some economists back in 2008, when this first started happening in a major way in New York City, of course, they got Starbucks to give them data, and they focused on just people who ordered something to eat. The people were getting beverages, yes, but beverages and something to eat. And they saw that just posting the calories caused people to order 26% fewer calories in their order. They're still ordering something to eat, but they're a little bit more careful. Just measuring, just drawing attention to something through accounting, through measurement, caused people to change their behavior. That's the power of accounting. So with respect to ESG, the question that we have is, can accounting help? Can accounting help us be better stewards of our environment, to be more socially aware and responsible, to have more legitimate and reliable and transparent governance issues? Can accounting help? Well, yeah, the key measurement principle that we teach our students all the time: you get what you measure. If you measure something, people are going to change their behavior. And that's what we're seeing already with ESG. So we want to talk about that with as it relates to accounting. Again, I mean, there are heavy opinions on both sides of this issue. Some people say we're not doing enough. We need to do more with respect to ESG. And other people are saying this is a waste of time. My brother and I are here as just simple accounting teachers. We're telling you what's out there, and it's something that's being reported and something that accountants are taking ownership for. How can we introduce this in our introductory accounting classes and expose our students to this material in a useful and meaningful way?
And that's the key, is they're going to hear about this. We need to educate them. We have an opinion neither here nor there. It's just information that ESG is asking for more information. Corporations in the past, they've operated on behalf of their shareholders, and shareholders are starting to say, we're impacting society in broader ways. So corporations are starting to pay more attention to ESG. And what is ESG? The effect of the corporation on the environment, on people's lives, societal or social, and then on ethics and transparency, how the governance issues that ESG faces. Now, what we're asking, or what is being asked of corporations, is what are you doing and how are you reporting it? And the doing part is not accounting related, but the reporting part is where accountants step in. So what we want to talk about today is, here are what corporations are doing, but from our point of view, here is how they're reporting what they're doing.
So just a broad overview, ESG, where are we? Awareness, we're becoming more aware. We read about this all the time, and many companies are taking symbolic actions. That's a start in making a difference. what some companies are worried about now is the strategic risk associated with ESG, because the last thing I want in this environment these days is to be exposed as a company that's doing nothing, whereas my competitors are doing something and reporting something. Stakeholders are starting to hold companies' feet to the fire. How come we're not doing more on the ESG front? uh, Measuring and reporting. We need better standards, better auditing. We're going to talk about that. This is very interesting. We can have a whole webinar on just this, but I'll give my personal opinion. As we start looking at these things and people do ESG actions and report those actions, then we're going to be able to start to hone in and make and use our skills, our cost benefit analysis skills. I mean, those things are still true. What things work better than other things? So we're not there yet, but we'll get there as we establish more data, more credible data. And Rome wasn't built in a day, but and old guys like me and old guys like my brother, you can see how old he is just by looking at him. We say, let's just take things slowly. But I'm glad there are young people out there because they realize that Rome wasn't built by doing nothing. So there's widespread encouragement to both do things and report things better with respect to ESG. And back to accounting, where does this fit, if anywhere, in the introductory accounting course? I don't know what you have experienced as accounting instructors, but I don't see I've got a lot of extra time in my accounting class. It's chock full of material already. So I think it would be unreasonable to say we should have a whole module, a whole week, a whole class day on just ESG. That might be going a bit too far, but there are places, nice places, to introduce ESG and ESG disclosures into an introductory accounting class, for example, as an example of disclosure in a financial accounting class. Auditing, we'll talk about that. It's a great illustration of the challenges of auditing and the opportunities. And in my personal opinion, management accounting, where you're talking about key performance indicators, KPIs, and the balanced scorecard, ESG fits in there beautifully in a managerial accounting class. So let's see where ESG and introductory accounting can come together.
Okay, and let me preface it with this. We're going to give you probably 30 slides worth of examples. At the end of this slide deck, we're not going to go through it, but at the end of this slide deck that you'll be able to download, there are 30 examples of ESG disclosure issues or issues that companies are facing that you'll be able to just fold right into your classroom tomorrow if it's relevant. So we're not going to go through all those examples, but those will be available for you to download at the end of this presentation. Now let's start first with E, environmental. We all hear about climate change in the news, and that's what this is getting at. What's our carbon footprint? How do we handle dangerous substances? What's our how are we doing with sustainability of the resources that we're consuming? Environmental is all about what's our business's impact on the environment in which we operate.
Here's an acronym from the C-suite that we've heard, CSO,
Uh,
and for years it meant the Chief Strategy Officer. And then as people were worried about data, Chief Security Officer. Well, these days, more often than not, it means the Chief Sustainability Officer, as companies want to very visibly show that they're doing something.
Here's an example. Walmart in 2020 reported that 36% of its worldwide electricity was consumed through renewable sources. And that was up from 29% in the year before. So they're quantifying this and reporting it. Their goal by 2035, 100% renewable energy. And what they said in the interim is by 2035, it's 100%. By 2025, they wanted to have 50%. And last year, they reported they hit 46%. So Walmart is taking steps to become sensitive to the environment and their impact on resources and their impact on the climate.
And already, just this makes me think, you know, people are corporations and companies are still run by human beings. So you can see that Walmart has set this 50% target knowing that they're going to meet it. They're already at 46%. They're strategically setting these numbers. This is kind of fun. We talk about big high-flying, high-minded ESG issues, but people are still people, and they're going to use these reports and this disclosure uh, to their advantage to make themselves good. By the way, Jim, I mentioned I was in Costco. I love, my wife won't let me live in Costco yet, but I love to be in Costco. Here's a sign that I saw yesterday in Costco. 100% of our seafood comes from sustainable sources. Now, I don't know what that means, but they're clearly marketing that to people. They want their customers to know that they are socially aware.
Yep, that's exactly right. And the point being, they've put these public goals out there. By 2035, we're going to be 100% renewable energy. The danger with putting it out there is there's pressure to meet that goal. And if you're not going to meet it, there are loopholes because there aren't formal standards, a lot of formal standards yet. It's easy to find loopholes. We're going to talk about that when we talk about greenwashing in a minute.
So many of you I know have told your students about earnings management, companies strategically making their bad debt estimates or their depreciation estimates so they can meet an earnings target that's been set by financial analysts. Okay, but that's nothing compared to the image management that's going to take place with these ESG disclosures, because with earnings, we've been working for years, 100 years, to fine tune the auditing procedures over those numbers so that companies don't have full discretion on what they report as depreciation expense or bad debt expense. We're at the beginning stages with ESG disclosures, and most disclosures are not audited. So the danger of companies being able to manipulate their image through these reported numbers is a very real one. And it's kind of fun to be here as this just starts. And I think it's important when we talk to our students about earnings management to tell them that this is a small issue compared to the image management that companies are attempting to do even as we speak with their ESG disclosures.
Yeah,
Now,
with ESG disclosure, it's the Wild West right now.
it is the Wild West. Yeah, it is the Wild West. The S is social activities, involve positive community involvement, emphasis on diversity, which we'll talk about a bit, equity in hiring and promotion, fair and protective treatment of customers, and so forth. And I'll tell you, it's hard to argue against this. It's hard to argue against kind of society forcing companies to be a little bit more transparent about the impact of their actions on society, their customers, their employees. Here's an example. It's 2022 ESG report. Walmart reported that that in 2021, 46% of the promotions among management staff went to women, 39% went to people of color. We don't want to get sidetracked here, but Walmart has had the company has had its feet held to the fire for years about this exact issue. And now with the ESG reporting and the expectations about the kind of things that Walmart should report, they're putting these numbers up front. And here's the thing. I don't want to be the manager that has to tell the CEO of Walmart, hey, we were 46% of promotions to management staff went to women last year, but this year it's only 42. I don't want to be that person. This just causes them to look at business differently. As an extreme example of a social activity, Walmart says that in June 2022, they stopped selling one brand of coconut milk. Jim, I don't know if you're a big coconut milk drinker. I prefer the raw coconut, but they stopped selling one brand of coconut milk because the supplier was using kidnapped and chained monkeys that were forced to climb trees and dislodge coconuts. And Walmart said, no, that's it. Now, the interesting thing is, what was Walmart's motivation to do this? Were they concerned about the monkeys? Well, let's be honest. They were concerned about their public relations image. But here's the thing. I think that's good for the world. The value of an international brand is a very high thing. And if now we are telling large companies, listen, part of the value of your brand is going to be linked to how you're performing on environmental, social, and governance issues. And so the companies, just to protect their images, the value of their international brand, are going to behave better. And in this case, it was good for these enslaved monkeys.
And the third part of the acronym, governance, has to do with decision making at the top level of a business, the composition of the board of directors, how executives are compensated. This one has been in the news lately with the auto strike. Uh, the UAW, the auto workers unions, arguing for higher pay, and they point out that the CEOs of these big companies are making $20+ million a year. They're just arguing for a little more of that. So governance has to do with disclosures related to composition of the board, decision making at the highest levels, executive practices, or ethical business practices, and so forth. As an example, next slide, Kay.
Well, just a second, Jim, before we go to the next slide, it just hit me. You've been on boards of directors for many years.
Right.
So what shift have you seen on the boards that you've been on as just more talk about
Uh,
transparency and other things?
the
What have
big
you
the
observed?
big the big difference is composition of the board. Is it a diverse board? And it's not because we want to check boxes. It's because different people think differently about business issues. And that was the value that we found, is when you get a diversity on the board, you get a diversity of opinion, and you start seeing things that my mind doesn't see. So it was good business. It was good for business, and not only good for image, but good for business as well.
That's a good point.
Here's an example. Apple, Microsoft, and Google all state that when they're looking for board of directors candidates, they're looking for diversity, gender, ethnicity, race. And for the first time in 2020, for the first time ever, all 500 members companies in the S&P 500 had at least one woman on the board of directors. That was a first. It'll get even better, but that was in 2020, it happened.
In a few minutes, we'll show them that slide that shows how it used to be, which is kind of
Yeah.
an amusing slide. Tell us about the Business Roundtable.
Oh, the Business Roundtable. That's a group of top business executives who get together and discuss business issues that affect their companies and other companies. And in 2019, they released a statement that said, not only are we committed to our shareholders, bullet 5 on this list, but we want to pay more attention to our customers, to our employees, to our suppliers, and to the community. So the Business Roundtable has specifically stated, we're bigger than just maximizing shareholder return. We've got other things to do. And as a precursor to what we're going to talk about, what they're finding is paying attention to these other stakeholders is good for their business. It's good for, in the long term, for their shareholders as well. And as of June 2022, 261 major companies have signed on to this and said, we are committed to recognizing more than just bullet 5, long-term value for shareholders. We acknowledge and will be accountable for how we treat our customers, how we treat our employees, how we treat our suppliers, how we treat the communities in which we function. So
Uh,
these issues are getting ahead of steam.
yeah, this shows. I was just looking for a quote in the 1970s. Milton Friedman, the late economics professor from the University of Chicago, Nobel Prize winner, and a conservative economic thinker, he wrote an article for the New York Times. The title of the article was "The Social Responsibility of Business is to Increase Profits." So you can see that society's view has changed a little bit. And this is a beautiful statement from the Business Roundtable, but we can all think a little bit, what happens when the interest of the shareholders and the suppliers and the customers don't all align? How do you weigh those different ones? We're in a complicated world now, but at least we've gone beyond just saying, hey, just maximize profits and don't think about anything else. So for years, we've had this corporate social responsibility report, CSR. That I think of these as general principles of vision, like a vision statement. What's the innovation of ESG? ESG is focusing on measurable outcomes. That's why accountants are talking about this. I mean, companies have been talking about their corporate social responsibility for years, but now we, the accountants, are coming in because people have realized, well, unless we're measuring and reporting things, nothing much is going to happen, or we're really not going to be sure what's happening. So that's ESG. That's the new innovation that ESG adds. Let's get measurable outcomes. So just a second. let me, one of the big we'll give examples of environmental, social, and governance. One of the big environmental issues is carbon emissions, or more broadly, greenhouse gas, GHG emissions. So just so you're prepared when this discussion comes up, uh, key thing is scope 1, scope 2, and scope 3 emissions. And they say, okay, great. No, this is really important. Scope 1 carbon emissions are the emissions from a company actually doing what they do. For example, an airline, flying airplanes creates greenhouse gas emissions. So that's a scope 1 emission. The company creates the carbon by doing their business. Scope 2 emissions are the carbon that is created from the generation of the energy that the company uses in its operations. Okay, well, for some industries, that's huge. For example, in the production of aluminum, or if we were in the UK, Jim, we'd say aluminium, a
Aluminium.
huge consumer of electricity. So a big carbon emission issue with respect to companies like that is how much carbon is created in generating the electricity that they then use in their operations. Google, you think, oh, Google. No, Google uses a lot of energy. So how much carbon is created in the generation of the electricity that Google uses in their server farms? I'm not much of a crypto guy, but if you know anything about cryptocurrency mining, it consumes a huge amount of energy. So that's a scope 2 emission. Scope 1, how much carbon is emitted when you're just doing your business activity? An airline is a good example. Scope 2, how much carbon is emitted in generating the electricity or other forms of power that you use in doing your business operations? Scope 3, I'll draw a line here. Scope 3 is one that lots of people like to skip over. This is the tough one. Think this is how much carbon is emitted by your customers when they use your product. So I'll just write down two industries here, the auto industry and the oil industry. So scope 1 and scope 2 emissions for an auto company, how much carbon is used in generating the electricity they use and running their factories. Okay, they can get a handle on that. How much carbon is generated for their actual production of the cars, they can get that. But then the big one, the one that's 20 times as large as the others, is, and how much carbon is emitted when their customers use their product, driving cars around. Oil, I mean, the production of oil, it generates a certain amount of carbon, and we know what that is. But once that oil is produced, how much carbon is released into the atmosphere through the customer's use? And we don't have time to talk about this in detail, but you watch as you see these disclosures, the environmental disclosures. Companies will often try to just skip past this scope 3 because it's hard to
I,
estimate and it's usually huge.
okay, let me insert this. Why is this
Yeah,
relevant to us? Accountants are in the measurement business. Somebody's got to measure this and report it. And accountants are in the measurement and reporting business. This is a business opportunity
that's a
for
good
the profession.
that's a good point. We're going to talk more about that when we talk about auditing. Also, with respect to carbon, to become carbon neutral, there are many companies, in fact, almost all large companies have said we want to be carbon neutral by 2050 to generate no net carbon. There are four general ways that companies address this. Uh, just reducing the amount of the carbon they emit. A Delta Airlines says we're transforming our fleet to newer airplanes, and they generate 25% fewer carbon for the same number of passenger miles. Offsets, this one is kind of controversial. For example, Apple paid to establish forests on barren land in Guizhou province in China to offset, remember this is a net number, so to offset some of the carbon they're creating in their operations. Credits, tradable certificates, and then this one is quite interesting. Exxon Mobil and other companies say, hey, if it's carbon we're worried about, we can suck carbon right out of the air, process it, and put it down in the earth in old, used up uh, oil oil fields. And it's been quite interesting to watch this discussion because what people really want to have happen is companies to reduce the amount of carbon that they're emitting. But this is another example of you get what you measure. Hey, if you want us to reduce net carbon, we'll start sucking it out of the air. And ExxonMobil has actually established an entire business unit to make money out of sucking carbon out of the air. So it's a classic example of companies just responding to the incentives in place.
By the way,
Socially, oh, go ahead.
let me say
Sorry.
this. If anybody watched the last Apple presentation, they had products, they had a phone, they had AirPods that they were releasing, but the big thing they discussed was the effect on the environment. 100, their new Apple Watch, 100% net neutral on the environment. So Apple's a company that's making a very big deal about this.
Now, and I can sense some of you saying, okay, why, we're going overboard with this. Well, maybe as a society, we are going overboard, but we don't know whether we're going overboard or not until we start measuring these efforts, quantifying these efforts, start measuring their cost and benefit. And that's where accountants come in. And that's why this is a very relevant and interesting topic to energize our students in that first accounting class. Hey, what's making this whole ESG work? It's accounting. It's yet one more confirmation that accounting is indeed the most important thing in the world. And our students should spend more time studying their accounting class and less time studying marketing and finance and those other useless topics. Accounting is where the action is. Social example, Dell reports in 2021 that it had dropped 8 of its 264 smelters that were refining certain rare minerals. They call them conflict minerals because they're often mined by small operators in Africa, and the money is then used to finance wars. So Dell is very sensitive to that, and in fact, they submit a report to the Security and Exchange Commission, the SEC, telling where they're getting some of their rare earth minerals, specifically these conflict minerals. And here's the thing: that should trigger a thought for many of you. Hey, if you're putting it in a report that you're sending to the SEC, that's a big deal. You can't lie in those kind of reports. So the SEC involvement of this really, in my opinion, has raised things to the next level. Ben and Jerry's promotes business practices. They want their suppliers to practice fair trade practices. And they say they're fair trade certified. And we'll talk about this in just a minute. What does that mean? That's kind of like auditing. They're saying our supply chain is fair trade certified. That means they've had an external party come in and look at their supply chain. That's an auditing function. So that's actually quite interesting. Governance, as Jim mentioned, new directors. There were 413 new directors selected by S&P corporations in the year 2020. 59% of those were women or men from an underrepresented minority. And as Jim mentioned, there's been research done that shows diverse groups tend to make better decisions than groups that are just focused. And you say, well, is this really a big thing? Have we really need to make any progress here? Let me just show you 2 things as we were developing this. 1925, here's the board of directors of General Electric. Now, look down that list and see these names: Gordon, Oliver, Dwight, Philip, Gerard. There's only one that's ambiguous at all. Francis, I'll bet that's a man, but I can't confirm that. And then even better, 1956, that's the year I was born. We don't need to say anything. Look at those people on the board of directors. And you don't see any diversity whatsoever. So society has come a long way already, because we had a long way to come. And this reporting that accountants are involved in, where companies are now held accountable for how they're considering these diversity issues, we're making some progress. We're much better than we were back in 1956, that's for sure.
Okay, when it comes to ESG reporting, that since there are no real standards yet, you can read ESG reports that are vague and really don't tell you anything. And in fact, as an example here, you can just go out to Google and search and say, okay, what's other people doing in my industry? Just go to Google and you can Google an ESG report. And in fact, we took the next step. We went out to Chat GPT and said, create an outline for a high quality ESG report. And by golly, that's not bad. Chat GPT has scoured the internet universe and come up with this. And you could use this outline as a framework for creating an ESG report. I mean, it's not that
Which
hard to
is,
do one that doesn't tell you any information.
yeah, and which is against, I mean, a credible ESG initiative should be part of a company's strategy, but too many companies, it seems, are just kind of doing the Chat GPT. In fact, Jim, what if you ask Chat GPT to give you some measures? Can it do that?
There you go. We asked that question. Here's the question we asked in blue. And Chat GPT returned 21 measures in 7 categories. It said, okay, measure and report this, measure and report that. Kay talked about scope 1, scope 2, scope 3 greenhouse gas. Chat GPT said use that as a measurement. So if a company wanted to, they could go out to the internet, download generic Chat GPT or ESG reports, come up with measurements from Chat GPT and report those as well. But as Kay said, it's got to be useful. It's got to be part of the strategic emphasis of the company. If you just want to check the box, Google and Chat GPT will help you do that. But if you want to make a difference, it's got to be a strategic part of the way the board thinks.
Let's
Here's
look at
some
a couple
actual
examples, Jim. Yeah.
Walmart. They reported that in 2020, they donated 627 million pounds of food to food banks. They measured that and reported it. Amazon reported that they'd reduced the weight of their outbound packaging by 36%. Everything doesn't come in the brown cardboard box anymore. They're making an emphasis to reduce that cardboard. Saudi
If you want to see
Aramco,
something fun, look at the you can find the YouTube video where Amazon and Tide detergent worked together to get a package that was the shipping package and the container for the detergent all in one to
yeah,
address this very issue.
you see a lot of that now. You'll see the shipping packet, the product package with a label on it, no cardboard box or anything. Another example, Saudi Aramco, 94% owned by the Kingdom of Saudi Arabia, so they have an interest in hiring people from Saudi Arabia, and they've reported over time the percentage of Saudi Arabian workers has increased, and they just keep they monitor that, they measure that, and they report that. That's what
And,
happened. That's what's happening with ESG.
And I like, that's a real good one because clearly that measure fits into their company strategy. It's important for the Saudi National Oil Company to be run and operated by Saudis. So they're measuring that. That does fit into their strategy. Other important, there are a couple of important organizations. With respect to financial reporting financial reporting standards, something with which we're all familiar, the ISSB and the FASB both created in 1973. And if you want to see a battle break out, get representatives of both those organizations, and they can argue about which one was created first, because they were both kind of in the middle of the year 1973. The SEC, of course, the United States regulates our securities markets. Well, that's financial reporting. For ESG reporting standards, there are also important organizations. The United Nations has had some sustainable development goals. There's a task force on climate-related disclosures, the Global Reporting Initiative, and it's something new that directly impacts us, the International Sustainability Standards Board, the ISSB. So let's talk about that one for just a minute. It was created in 2021 by the same oversight group, the foundation that oversees the IASB, which sets international financial reporting standards. So this same group kind of reached out and said, hey, we've been overseeing international financial reporting standards for years. Let's look at international sustainability standards. And so this board was created under the same umbrella as the group that makes international financial reporting standards. So this is my opinion, but I'm biased because I'm an accountant. I think this is a good development because the IASB, in charge of establishing globally accepted financial reporting standards, that's a group that knows how to organize themselves and create, they know about the processes of setting standards that are going to be accepted around the world. Second, accountants are naturally interested in ESG reporting because ESG issues impact asset values, the amount and timing and risk associated with future cash flows. So this seems like a natural thing. Why are the accountants involved? It's a natural thing. It's in our wheelhouse. And if I were the rest of the world, I would say, okay, this is great. I'm glad that the accountants are involved in this. So the International Sustainability Standards Board, they've issued their first 2 standards, general requirements for disclosure, climate related disclosure, and the accountants being involved means we're going to get some rules that people can understand, and rules that can be, you can audit companies' disclosures. So people are going to be able to rely on these disclosures. So they're up, they're running the ISSB, the International Sustainability Standards Board. Now, what's interesting is, in my opinion, I know they're doing a good job because they're being complained about from both sides. So if both sides, there are environmental activists, for example, are saying you're not doing enough. They often talk about something they call double materiality, where, yeah, there's financial materiality and in fact on cash flows, but there's also societal materiality. How much impact is a company having on society? And they want disclosures about both. So they don't think the ISSB is going far enough. On the other side, there are traditionalists who say, hey, what are we wasting our time for? Kind of the same issue that we've heard about mark-to-market accounting. So if both ends of the spectrum are complaining about you, that means you must be doing something right, I think. And we have to start somewhere. And leveraging the long experience of making a worldwide financial reporting standards, it's a good way to establish the credibility of this effort. Now, Jim, what about auditing?
And here's the market opportunity. How do we know these numbers that companies are producing are reliable? It turns out in 2021, 95% of the largest 500 companies in the United States provided detailed ESG information, but only about half of those companies provided independent third-party assurance. So people are disclosing, but only about half of those disclosures have been looked at by independent third parties to say, yep, we've checked the numbers. And the interesting thing, for that half of the companies, the assurance provided by those who are reviewing the numbers is limited. So at this point, again, it's the Wild West. At this point, we're not sure we can have a lot of confidence in the disclosure. First of all, half the companies, 95% of the companies are doing it, but only half are having it reviewed by outsiders. And of those outsiders, it's very limited what they're doing. Well, it says here, this is a big opportunity for accounting firms, for example.
Yeah, they can complain, but there's money to be made here. Ooh, I shouldn't say that, but there is in
Yeah, and
verifying these
here's an
numbers.
example from Walmart. Walmart says we sought and received external assurance from a third party with respect to certain emissions information in our reporting. We did not seek or receive external information from third parties. So they try, but the market hasn't developed enough where they can hire someone to provide confidence in their estimates. So they're looking for, companies like Walmart are looking for people to step in and say, we can help you here. And there are other companies who are saying, we're not looking for anybody. That's the business opportunity.
And because these numbers are not audited in a way that we traditionally think, there's some wiggle room. So let me give you 3 examples. Greenwashing is the name given to this, really manipulating your ESG disclosures. This title came from an article that a person wrote back in 1986. They noticed that hotels were encouraging towel reuse. And you've seen this, you've been in hotels. They said, to help us save the environment, reuse your towels 14 times and then we'll wash them for you. Or if you're going to stay here multiple days, we're not going to change your sheets. And they try to virtue signal, say we're doing that for the environment. Well, they're doing that to increase operating profits and save money. But there's no real regulation on what you can and cannot disclose in your ESG disclosures. So hotels are using it to their advantage. Coca-Cola, they're part of the ocean cleanup, an initiative, and they're getting plastic bottles out of the ocean. That's great. So they trumpet that. But on the other hand, they still produce 100 billion plastic bottles per year. Do the math, that's about 13, 14 bottles for every man, woman, and child on the earth every year. So they could kind of cleanse their image with a disclosure about their involvement in the ocean cleanup. Maybe the most
They make the
notorious
mess,
example.
they make the
What's that?
mess, and then they make the mess, and then they help clean it up.
Clean it up. The most notorious example, Volkswagen. I mean, if you haven't ever read this story, you should go find it. They developed, their engineers developed software that would allow a car to detect when it was being tested. You know, if only the back wheels are moving and the front wheels aren't, you're probably in a test. So they would go into a different operating mode that would be very efficient in terms of reducing emissions. But when under normal operating conditions, the emissions went way back up. So since there were no real firm regulation on what you could do and what you couldn't do, uh, they did this to kind of get around. This is another example of greenwashing, but it's also a cautionary tale. They lost a huge amount of market value and a huge amount of reputational value by doing this. Companies are realizing that, yeah, there is this wiggle room, but the public will punish you if they find that you've misrepresented your ESG performance. So why, Jim, why are accountants involved in all of this?
Well, as it says here, what do accountants do? They measure. Now, in the past, we've focused strictly on measuring things that we can quantify in dollar terms, but we can measure other things. We're in the measurement business, and somebody's going to have to do this. Someone inside the company is going to have to do this measurement. So, you know, we as accountants can sit back and say, well, somebody else is going to do that. But it's an opportunity. Somebody's going to measure this. And we as accountants are in the measurement business. So it's a business opportunity. It's an opportunity for the accounting profession to say, we're going to measure more than just dollars. In addition, why are accountants involved? We're known for independence, particularly external audit firms. We're known for independence, and the audit process is known to be rigorous. And that's what has to be brought to the table for this ESG to work. As Kay said, with the ISSB, we have a history of developing standards that apply in the US for the FASB and internationally for the IASB. We have a history of standard development. We ought to be in this business. And then, as Kay also mentioned, this does affect future cash flows. ESG affects future cash flows, and what businesses are about are assessing future cash flows. Auditors, accountants are heavy into future cash flows, how to quantify and how to measure and quantify the impact on future cash flows. That's why accountants are involved. Now, as I said earlier, following the slides we're going to go over here, there are 30 plus more slides that walk you
Jim,
through
are they going to get
specific
these slides that
examples.
we're looking at? Jim, are they going to get
Yes,
these slides that we're looking at?
yes, those Stu Kent will provide those slides here shortly. You'll be able to
No
download
extra
these.
charge, ladies and gentlemen, at no extra charge.
That's right. Download these slides. Take what you want, put it in your classroom. Just as an example to put it in your classroom to let your students know this is what's coming, and accountants are going to be in the thick of this.
There's some really fun things. Airlines are doing some really interesting and strange things to reduce their carbon emissions. So we've got slides on that. Other energy sources is code for the nuclear power industry. They also have ESG disclosures, which are interesting to look at.
All of these examples you'll just go, wow, I didn't know that. Oh, wow, that makes sense. And you'll see that somebody's going to measure this and somebody's going to audit this. And we're in the measurement and auditing business. So it's going to affect our students in the relatively near future. Why is this? What is ESG about currently? What are companies doing? How are they reporting what they are doing? And as we've hopefully pointed out, at this point, there's a lot of wiggle room, and standard setters are going to step in and reduce that wiggle room so that we can have confidence in ESG disclosure.
Now, we mentioned earlier, where would you put this in an introductory accounting course? Here's what we think. It's a great example of disclosure. It's not disclosure that's part of the formal financial statements that is underneath the formal audit, but it illustrates the issues of disclosure, of kind of telling people what's going on out there, and issues of auditing. Are these numbers audited? So it's very, in a financial accounting class for introductory students, ESG provides a good opportunity to make the issue of disclosure and audit, those two issues, disclosure and auditing, come alive. Students will definitely be interested. I think that management accounting is a great place to put a module on ESG, where you're talking about KPIs and the balanced scorecard. In fact, when we're finished with this webinar, Stu Kent will send out to you, it's about a 13-page module from our online textbook that we have prepared for Stu Kent that you're welcome to let your students read it. It's 13 pages. It'll give your students a broad background on ESG and reporting and how accountants are involved, to cover some of the issues that we've talked about here. And that's yours to use. Please, if you want your students to get a background in ESG and reporting, go ahead and look at it. And since Stu Kent is sponsoring this whole thing, we thought we'd just take a minute to tell you some of the amazing things that they've got. They call it a simternship. It's a simulation. It's an amazing piece of work that I think you want to see. It embeds students in a real life work setting with video messages from a supervisor. This is not a pencil and paper practice set like I did when I was going to school, or a bunch of PDF files. No, this is an interactive online environment. Messages from the supervisor, invoices emailed from suppliers, journal entries, and done in a QuickBooks-like environment that takes students all the way through the start of a business, making business decisions, day-to-day accounting, adjusting entries, closing entries, preparation of financial statements, taking those financial statements to a bank and asking for a loan. This is an awesome piece of work, and this simulation design is flexible. It can be used with any accounting textbook that you happen to be using. So if you want to, Stu Kent representatives will send you a link. In fact, I think they're going to send it to you whether you want to or not. Just click on it, and it's a 15-minute walkthrough of this amazing accounting cycle simulation. I guarantee you've never seen anything like it. It's really something, and you can also set up an online demo with them. We've been talking about ESG, use in introductory accounting. We thank Stu Kent for hosting this webinar for us. And Jim, I think it's probably about time for you and me to be quiet for a minute.
Yeah, and I'm good at that.
Good. Abby, we turn it to you.
Stop your screen share there, Kay.
I have to undo my screen share.
Yeah.
I'll get there.
Oh, we'll wait.
Okay, you're going to have to. There you go.
There we go. Abby, are you available?
Hi guys.
And everybody who's watching this right now just said the quality of this whole thing just went up. Let's get those old guys off the screen and let's get a young person in here. So there we go.
No, thank you so much, Jim and Kay. We'll be having our Q&A coming up in just a second. So you have a minute to get some more questions in here. We had a couple come through already, but before then, we're going to show you a couple of resources and make sure some links are available to you before we get to that Q&A. So first, we're going to have a video from our CEO, Stu.
Hi everyone. At Stu Kent, we're on a mission to help educators help students help the world. We create up-to-date, turnkey materials that save you time and make your job as an educator a little easier, and your students' jobs a lot more engaging. Our first in the world simternships, or simulated internships, give your students real world practice with the concepts that you're teaching them. These powerful simulations work hand in hand with our courseware. StuKent courseware gives you great resources like detailed lesson plans and auto-graded chapter quizzes, while your students get an accessible, engaging digital text. But you know what? While these materials are ready to be released, our work on them is never really done. StuKent's slogan is Stay Current. We update our courseware and simternships annually to keep them current with what's happening in your industry. If there's something you think we can improve, let us know. Consider us your custom simulation and courseware provider. If we don't make it just the way you need it, we'll keep working on it to make it better. We're dedicated to bringing you the best simulations and courseware in the industry, and we're not going anywhere. Over the last decade, we've experienced explosive growth, and we now offer more than 40 simternships and courseware bundles across 4 different categories: marketing, business, communications, and accounting. To date, we've helped nearly 1 million students at schools all over the world, and we can't wait to help you and your students next. Today, we're going to explore some great topics, ideas, tools, and strategies that can help enrich your curriculum, enhance learning, and keep you current with your industry. Throughout the event, feel free to chat in any questions you may have. The StuKent team will be standing by to help you. And if you enjoyed today's event, you can visit stukent.com to get connected and see a schedule of our upcoming launches, fireside chats, presentations, and more. Each month, we host events just like this one, and we're building some great online communities for professors in the marketing, business, communications, and accounting spaces. We want to give you a place to meet new colleagues, collaborate on ideas, and share your professional insights and brilliance. So, thank you for joining us today. I hope today's event helps you, help your students, help the world. Enjoy the show.
All right, thanks to Stu for that video. Now we're going to hop into some of the questions that we have, and I did pop up a request access for the financial accounting, and we'll share a link in a little bit as well for the managerial accounting, which does have, correct me if I'm wrong, some ESG materials included in it, right? All right, so first question, what will be the effect of CRSD requirements in the US?
So the CRSD, this is coming from Europe and the European Union, and here's the state of the world. Europe is about 437 light years ahead of the United States on ESG issues in general and ESG disclosure. So what's going to happen? I mean, there's no direct effect, but they'll, if as Europe tightens up, because they're the leader, tightens up their requirements for ESG disclosures, that's going to naturally push back, and US companies are going to be held to the same standard by international investors. So there won't be a formal link, but it'll be an informal link as US companies realize we got to catch up. That's a good question.
And we see this example with this right here. This is a USB-C connector. Europe requires Apple to change their phones from a Lightning connector to a USB-C connector. And Apple has done that, not because they wanted to, but because they're being required to do that in Europe. Again, as Kay said, Europe's leading the way. We're doing away with this here and requiring this because Europe is moving that direction. They want to cut down on how many cords we have, the impact on the environment, and the effect on individuals. So we're going from this to this because Europe required that.
Kim, I see that Kimball. So this is the same thing. This is the same question. Kimball asked, where does it say the SEC requires ESG disclosure? The SEC is talking about requiring SEC disclosure. I don't think they've come through with a final pronouncement yet, but they've been talking about it pretty seriously for at least 18 months now. But what companies are doing, the Dell example that we gave, some companies are getting out ahead of this with voluntary disclosure. And that's for years and years, that's been a way for a company to signal its quality. Even though the SEC doesn't require us to submit to them a conflict minerals report. We're doing it anyway, because we think that the actions we're taking are very appropriate, and we're not afraid to tell about it. We're willing to be transparent. So I think that's where things are now. Companies are submitting things to the SEC, but in terms of formal standards, we're not there yet. But the SEC is talking about this all the time.
Yeah, I'm actually looking at the SEC's website right now, and they've proposed rule changes, but I don't think that those have been passed yet.
And
So
somebody's
they're starting to get into this
some
business.
companies are getting out ahead of this. That's a
That's
good way
right.
to say it.
Thank you. And then addressing David's question, can you get a video recording? Yes, we will be sending this out in the slides and the other resources that we're about to pop up in your screen as well after the event. So thank you.
And David, remember, there's no extra charge. You get this video recording for free. It's all part of one package.
Happy to do it. Happy to do it, actually.
And then I have some extra questions on my side as well. When would you talk about ESG in an introductory accounting course? You covered that a little bit. Are you thinking the beginning, the middle, the end? Where do you think your students need to be?
No, that's a good question. And as we said, in a financial accounting course, I'd included it when you're talking about disclosures. Often in the second chapter of a book, you talk about financial statements and then you talk about disclosures. It'd be a great time to just introduce a little bit. Here are some other types of disclosures that aren't in the formal notes of the financial statements, but the kind of things that accountants are getting involved in. And then in a financial accounting course, when I talked about auditing the financial accounting numbers, that's a nice time opportunity to segue into ESG and say a big issue with these numbers and give them some examples like the ones we gave today is how reliable are these? Who's going to audit these numbers? That's a great place to talk about it. Then, Jim, go ahead.
Here's a selfish point of view. When you're talking about financial statements and the footnotes to the financial statements, and then you throw in Walmart gave away 627 million pounds of food last year, and for the first time in history in 2020, all board members had at least one woman on them. That's going to cause students to think about what you're teaching differently. They're going to say, oh, this isn't just numbers. I thought this was just dollars and cents. No, accounting is growing bigger than just numbers. And that's going to entice people to pay a little more attention.
And that's why another good place to talk about ESG issues, as we mentioned before, when you're talking about performance KPIs and balanced scorecards, ESG reporting fits in that module in a managerial accounting course just perfectly. It's a perfect match.
When Jim and Kay decided to partner with Stukent, they actually came to our offices and gave us like a demonstration of their courses, the way that they teach and their work. And it was really engaging, and it made me be like, I want to go back to school now and retake my accounting courses. So I'm really great that you guys are able to share what you know with everybody today. So thank you so much for coming on. I lost my assistant, so I'm going to be sharing some things myself right now. This is a link to the managerial accounting courseware that is available for you to get instructor access to, and all the wonderful resources included in there from Jim and Kay. And then I'm going to pop up in the handout section of your screen the presentation slides and the ESG information packet. And we'll be sharing these again at the end of, or when we send out the recap email and on the page where this video recording is going to live. We did get a question, where can I access recordings and slides from past sessions? So we've done quite a few webinars this year with Jim and Kay, and those all live on the Stukent site under our webinars tab, where you can see everything that we've done this year and other topics as well, like supply chain, intro to business, marketing, and communications as well.
We did a really fun one. Was it about a month ago, Jim? The ChatGPT one? That was a fun one.
And what that's going to do to accounting education, that's just interesting.
That's a good one. Thank you, Abby. Thank you very much for hosting us.
Of course. Thank you, everybody, for joining us today. And we're going to hop off stage so we can close off the webinar. But thank you, everybody.
Thanks, you guys.